Hey, welcome to another episode of Mortgage Minute. I'm Jeff Harrison. I'm just the guy behind the scene, and Art Alvarez is our host and our expert when it comes to everything about mortgages and loans for your home. And he's just finishing getting a little makeup done. He should be here in just a second. But I'll tell you what, we've got some pretty hot potatoes. I know he's going to dress up today, and I'm excited for him to jump in there and do that. I just want to remind you, if you're joining us live, and you have questions about anything we're talking about or something that is even off topic, I'll be behind the scenes and I'm going to be entering your questions, giving them to Art, and then he'll address those. If for some reason, hey, you're catching us on a replay, put your questions in the comments anyway, and we will get to those. So before we get going anymore, let's bring Art in. And hey, welcome, Art.
Thanks, Jeff. How are you?
It looks good. Good. You look good. You ready to go?
I'm ready to go. Yeah, we've got a lot of interesting things, a few interesting things to talk about. So,
all right. Well, I'll get out of the way and I'll turn it over to you, and I'll just be behind the scenes, and I'll be listening and you guide me through.
Okay, will do. Thanks, Jeff. Well, welcome everyone to this week's Mortgage Minute by Mortgage Works. My name's Art Alvarez. Got a few things to talk about. One in particular that's kind of becoming big news. So let's jump right into it. First thing I'd like to do, though, of course, is kind of give you an update on what's going on with mortgage rates. So in that regard, of course, the first thing I'd like to alert you to, and of course I talk about this all the time, is where are we at on the 10-year Treasury bond yield? And again, I bring that up because that is what I consider your best benchmark to track the direction of mortgage rates. So if you look at the chart, actually a chart from today, that is actually a 5-day chart of the 10-year yield, you can see how that yield has moved over the past 5 days, right there in the sort of middle upper part of that slide. And you can see midweek, we actually got down to some pretty low levels, down to below 3.4 again. Of course, it ended up closing today at 3.52. And that's kind of an interesting move because some of the economic data that has come out this week, I'm not sure would necessarily suggest an increase in bond yields. I think, though, today we had a big rally in the stock market, over 500 points. And so I think this is really more about what we call flow of funds, where on some days economic data is overridden by just, strong activity in the stock market. Again, over 500 point inflow into the stock market, that will pull money out of bonds. And so there could be an update in yields because of that, or uptick in yields because of that. So then what does that mean in terms of actual mortgage rates? Well, the best source to go for interest rate indication on residential mortgage rates, go to our website at mwloan.com. Right on the homepage, we have a rate grid. Now, and this rate grid includes a variety of programs. I've got 3-2-1 and 2-1 buy downs. I've got conforming 15-year, 30-year fixed, FHA, VA, jumbo, both fixed and hybrid arms, or what we call fixed arms. And I like to call this grid interest rate indications because that's really all they are. As you may know, the actual interest rate you're going to get on a loan when you apply for it is going to be based on a variety of factors. And so these are just indications of average rates where they're at right now. They are based on specific parameters. And then the other thing I'd like to point out is at the bottom of that grid, you can see a tab for a link for about mortgage rates. And I would encourage you, if you haven't done it before, to click that on, because I provide you a little bit more in-depth discussion about how mortgage rates are determined. There's a lot more into that than a lot of people think. So in terms of what's going on this week that might be affecting mortgage rates, well, there's a couple things. In fact, one of the bits of data that just already came out is GDP for the first quarter. Well, it's come out at 1.1%. That's, of course, a drop from the previous quarter, and again appears to be some more signs of maybe coming weakness in the economy and the potential for a recession. Although, if you remember from last week's program, I saw a discussion or a presentation from a pretty good economist suggesting we're not going to see a recession for the next couple of years. So we'll see where that goes. Now, the other key data that's coming out this week, actually tomorrow, and this will be a good test for any of you who are interested to take a look at the 10-year bond yield chart in the morning after the market's open. Tomorrow, the core PCE, that's personal consumption expenditures, is going to be announced. Now, what this is also known as the core inflation number that the Fed actually focuses on primarily. It's called core inflation because it excludes food and energy prices. So this is considered a more indicative indication of where inflation is at a core level when you throw out the volatile segments of energy and food. So we'll see what happens tomorrow. In February, that came out at 4.6 on a 12-month basis. That was down from 5.3 for January. So we'll see where it comes out tomorrow. But if there's further reduction, I think that could be good news for the bond market and therefore good news for mortgage rates. So that's where we're at on the mortgage rate update. Now, here's the interesting news that I really been looking forward to talking about. And that is something you may have heard about it. All kinds of news suddenly occurring really just the last week or so. And the basic crux of this, the news flashes are, the news headlines are, the better your credit score, the higher your rate. And of course, on the slide, I put, because that's sort of counterintuitive, right? Better score, you should get a better rate. And that's frankly, traditionally how it's always been. But guess what? This is actually not new news. This was actually came out of the Federal Housing Finance Agency, known as FHFA, who oversees Fannie Mae and Freddie Mac. And actually, you can go back to March 22nd when Fannie Mae and Freddie Mac issued new grids for what's called LLPAs. So LLPAs, what are those? Well, that's an acronym, of course, for loan level price adjustments. And this is a grid that reflects different adjustments based on certain credit and property criteria for a borrower. And it runs a variety of things, property type, credit score, loan to value, and things like that. It's a pretty complex grid, actually. And what's happened is, again, going back to March 22nd, but for some reason not noticed until the last week or so, is the agencies have tweaked this grid to where they have added higher LLPAs on higher credit scores, and they've reduced the LLPAs on lower credit scores. Now, these LLPAs, again, loan level price adjustments, are a price. They are a fee. But in a majority of cases, when mortgage loans are originated, these LLPAs are absorbed into, guess what, a higher rate. So as it turns out, yes, the agencies did make this change back in March, but for some reason, it didn't really catch on with the news media until very recently. And there's a couple of things about this that I would want to point out. First of all, the agencies added 2 new categories for the LLPAs as it relates to credit score. Now, it used to be until this change, on a conforming loan, you're going to get the best rate if your credit score, your middle credit score, when you're getting a 3-bureau report, had to be 740 or higher. That's no longer true. Now, to get the best rate on a conforming loan, again, a Fannie, Freddie Mac type mortgage loan, 30-year fixed, 15-year fixed, whatever, now you have to have a credit score at 780 or higher to get the best pricing on the loan. And there's an additional category, 760 to 780. So now, if you're at 740 to 759, you're now only in the 3rd best pricing level for a Fannie Mae, Freddie Mac conforming loan. So this is a pretty significant change. Now, the other thing is, when you look at the grid closely, where there are increases for higher credit scores, predominantly pretty much in a narrow range of around 80% loan to value. That's where the biggest changes are, both in terms of increases to high credit scores and improvements to lower credit scores. Now, where it looks like the lower credit scores benefit is 680 or actually below 680. Now, one of the things I want to point out, though, is when you put this all together, is this going to impact the rates on higher credit scores? Yeah, not a huge amount, probably 1/8 to 1/4%. On the lower end, it could improve the rate for a lower credit score borrower, maybe by the same amount. Now, I've heard some suggestions that, well, if you're already below 680 and you're going to get a better deal for a mortgage, even though you are under 680, why should I worry about getting my score any better? I should just be happy with what I have. I wouldn't suggest that. Keep in mind that these changes, in terms of improving the LLPAs on the lower credit scores, these changes are what I call just less bad, for not the greatest English. Before, if you were at a 620 credit score, with 20% down, the LLPA just for your credit score was going to be 3.5 points. Well, now it's 2 3/4. So you have a little bit of an improvement, but 3/4 of a point absorbed into the rate is maybe an eighth in rate. So it's not that much of a benefit. I would encourage anyone who's thinking about, not worrying about your credit score as much because of these changes. Don't think that way. It's always best get your score as high as possible. And of course, now you got to get all the way to 780 in order to get the best pricing. Now, here's what's really interesting about this, and then we'll move on. Part of this same announcement was changes in loan level price adjustments for higher debt ratios. Yes, that's right. What was going to happen was a borrower, if their debt ratio was over 40%, and frankly, folks, a lot of transactions are above that number, many of them in the 43 range, as high as 50 or 49.99. So the idea was this same announcement was going to involve a loan level price adjustment increase whenever your debt ratio was over 40%. Now, this is the part of the overall announcement that caught the attention of industry participants, and there was a big pushback on that, and that was successful. It was initially pushed back to not be implemented till August. Now, my understanding is it's been pushed back until next year. And that's another interesting tweak, because think about it. If you're over 40, let's say you're 41, you're going to then pay a higher price for your mortgage, which means a higher rate, which is then going to push your debt ratio even up a little bit more. So it seems a little bit punitive. And again, the industry, at least for now, has successfully pushed that back. And of course, going back to these adjustments for credit score, there is some talk that there's some political issues involved with this. I'm not here to talk about that. But I have a feeling that because, Washington, D.C. has become sort of aware of this, there could be more news about this. I'm not sure. It's already implemented. And whether or not it can be rolled back, we'll have to wait and see. So an interesting situation, a lot of news lately. I wouldn't panic. Oh, by the way, for any of you, I'll call you mortgage geeks. If you'd like to see a copy of the new LLPA pricing grids for conforming loans, I'll be happy to send you a copy. Just get in touch with me, and I'll be happy to get that to you. So then on the next issue I want to talk about, and I'm bringing this up only because in recent, actually several months now, I've had some borrowers react and contact me after we've initiated a loan, whether it's a first mortgage or in particular when we've been doing a lot of equity loans, a lot of HELOCs and fixed rate seconds. And what's been happening is we'll start the transaction. We do have to pull up a credit report, a full hard query, 3-bureau credit report. And then after doing that, usually within a day, I'm getting a call or email from my borrower, text message. What's going on? I'm being bombarded with marketing calls. I've got over 100 calls. What's going on? Well, as it turns out, what that entails is something called in the industry trigger leads. And so let me tell you how that works. Like I just described, someone comes to me, let's say for a home equity line of credit, a HELOC, and we initiate the transaction. I pull up, 3-bureau hard inquiry credit report. What that does is it creates the inquiry. And then guess what? Like it or not, the credit bureaus, Experian, TransUnion, Equifax, once that mortgage-related inquiry has been created, they can sell that data, that info, to other lenders, other mortgage originators. And this is not new. This has been going on for years, decades. However, what's changed is the level of response when these leads get sold. Now what's happening is the level of calls the applicant has gotten after they've applied with a mortgage lender has just exploded. I literally have had customers recently telling me they've had over 100 calls. Kind of makes some sense. Mortgage business is not as active as it was. Rates are up, refis are down, purchases are still kind of challenging. A lot of lenders are lacking for volume, and they're doing anything they can to try to gin up some new business. So now, whereas in the past we would do one of these and maybe there'd be a couple of trigger leads calling the borrower, now there can be dozens and dozens, and maybe 80 or 100. Can be really aggravating. It's kind of harassment. I'm kind of surprised that this is even allowed to happen. But the point is, you can opt out. And on the screen here, I've got the information for you to be able to opt out. You can go to optoutprescreen.com, or there's a phone number here, 888-5-OPT-OUT. Again, 888-5-OPT-OUT. So you can call or go online, and you can opt out of these pre-screened trigger leads, so that at whatever point in the future you are looking to apply for a loan, you can avoid that kind of harassment, as I call it. And of course, there's a website you can go to, excuse me, to get more information about trigger leads and how to avoid them. So just be aware of that. Again, it's something that I think is a real nuisance, and I'd like to see this cut back, so that mortgage applicants, whether with us or with somebody else, doesn't have to go through that kind of experience. So next, what I want to talk about a little bit is sort of a featured program update. One of the things we talked about last week, and I just want to remind you of it, it's a really cool program. Again, it's the alternative for a senior homeowner who does not want a reverse mortgage. They've got a small first mortgage, they're paying fine on it. They've got retirement income, so they don't want to touch that. They've got lots of liquid assets, but it's all invested. They don't want to touch that, but they might have a huge amount of equity in their home and they want to access that. This gives the senior homeowner an alternative to the reverse mortgage, where they can pull anywhere from $50,000 to $4 million and get a junior lien with no fixed term, no monthly payments, interest rate as low as 8.99%. Credit score can be as low as 600. It's a great program, great alternative for that reverse mortgage prospect who doesn't want that, but still wants to tap into their equity. And then the other thing, which I've mentioned recently, just a reminder, because it's a hot deal, jumbo loans to $4 million for second/vacation homes. You get the same rate, same loan to value available as a primary home. That's a big deal. Second home loans are not priced well at all anymore like they used to be. They're now priced like rental properties. So if you're looking for a vacation home, whether here in the Palm Springs area, up in the mountains, at the beach, wherever, and if you need a jumbo loan amount, check with me. Be happy to send you some numbers. Again, we can get you a second home loan up to $4 million, same rate as a primary home. Again, it's not for everyone. Access is restricted, so I've got to get information from the borrower and then submit a request actually to get access for the program. It's that good, and it's for very well qualified buyers or borrowers. So you do have to be pretty well qualified. Although the underwriting criteria, the qualifying criteria, is not really all that unreasonable. I think we're finding a lot of borrowers can meet the requirements. And then lastly, what I wanted to mention something is, from time to time and over the years, it's remarkable how many times maybe I've encountered someone who's already dealing with another lender and they're maybe having a problem, and and then part of the conversation I'll ask, well, what kind of terms are you getting? And most of the time I'll get an answer that says, well, I don't really know, which is kind of odd, because with the way the mortgage business works now is, if they've gone as far as applying, they are going to get an LE at some point that's going to tell them what the terms are. But that doesn't mean they really pay attention to that, or that anybody took the time to explain what they're looking at. And when we start a transaction, even before we do, it's my practice to always send a detailed, itemized closing cost worksheet that lays out the prospective scenario that the borrower is pursuing, in particular on a purchase transaction. Now, of course, on our website, we have a calculator that you can plug in a loan amount and an interest rate and get a monthly payment. That doesn't really tell the whole story, particularly if, like, for example, you're a first-time home buyer. You might be thinking, okay, I'm going to go find a home to buy for $400,000, and I can buy that home with 3% down. That's only $12,000. I only need $12,000. Well, not really. You need more than that because of closing costs and so forth. So in my mind, I thought, what would be better than for me to at least extend an offer to our viewers where, whether yourself or someone maybe a family member, and they're kind of mulling over getting a mortgage. Maybe they're going to be looking to buy their first home, or maybe they're looking to sell their home and buy something, move up, or maybe they're contemplating a refi. And you'd like to get a little more information, but you're not really ready to contact a lender and kind of get sucked into the process. Drop me a line, send me an email, a text, call me. And with just a little bit of information, I can give you a very detailed, itemized closing cost worksheet that will provide you some very specific information. And of course, once you get it, if you have questions, then I'm happy to kind of translate it for you and explain what it means to you when you get it. And to get this, it's very simple. I just need a purchase. Let's say we're talking about a purchase transaction, a purchase price. I need a credit score, at least what you think your credit score is, what you desire for your down payment amount, what type of property. What I mean by that is it a single family home? Is it a condo? Is it a 2 to 4 unit? That kind of thing. And property use. What do we mean by property use? Well, what we mean there is, are you going to occupy it as your primary residence? Are you buying it as a second/vacation home where you're going to use it part of the time, and maybe part of the time it's going to be generating short-term rental income? Or maybe you're buying a rental property. So with that, those 5 bits of information, change purchase price to home value if you're looking at a refi, I can, just with that, I can send you the details, and then you can mull that over, and that'll give you a better idea really what's involved in getting the mortgage, and give you a fuller picture of, the total cash to close, which is not just down payment, it's down payment plus closing costs, breakdown of your payment, including principal and interest, taxes, insurance, HOA dues, if there are any. One of the things I always try to do is, if there is a specific address that's being provided, then I can even look up the property taxes, make sure they're accurate, and so forth. So again, no obligation, just a way to get some little more detailed numbers without having to apply or send me all your personal information. And this way you get a little bit more education, a little bit more informed, so that you're better prepared when you're ready to go out and get that mortgage. So that's what we have this week on the Mortgage Minute. Jeff, I'll send it back to you, see if we have any questions.
Art, great job as always. That's really good. I just want to put this next slide up here that has some information on how people can contact you, and that has your office number and your website, and then your additional information there. But it doesn't have your cell phone on there, so I'm going to put your cell phone down here, and that's 714-612-9035. There was one question. That it says the website you showed us, is that something, that 10-year treasury, is that accessible to anyone, or does that have to be somebody who's a lender?
No, actually the 10-year bond chart that we showed earlier, that's not on our website, although it might be a good idea to do that. But the 10-year bond yield chart is readily available from a multitude of websites that are accessible by the public. Yahoo has a Yahoo finance page. CNN has a CNN finance page. Here, this is a website called Market Watch, which is very focused on financial markets, including the mortgage industry. So this is one I tend to go to. Again, it's very easily accessible by a consumer. So, choose whatever, site you prefer to get this information. But the U.S. Treasury, bond yield charts are readily available and should be easy for anyone to access at any time, day or night.
The other question was about the your offering as far as the free what do you call that, closing worksheet?
Closing cost worksheet, yeah.
Closing cost worksheet. Is that and you would like them just to send that to your email address?
Yeah, they can send me an email. They can send me a text message. Now, in order to send back the worksheet, I would recommend, provide me an email address to send it back. It's just, easier to transmit, easier to read. But yeah, they can, email me, send me a text, or even call me and just say, hey, I've got a scenario I'm thinking about. I'd like to get a closing cost worksheet. Send it over, please. And I'll be happy to do it. And the key is, part of the reason it's called a closing cost worksheet, and you'll see it at the top of the form, is it's not an official disclosure document. So in that respect, right on the form, it'll say this is, to get, an official estimate, you have to request a loan estimate from a lender. Well, of course, that does require, formally applying for the loan. But a closing cost worksheet with that appropriate disclaimer at the top is a, accepted means of providing specific numbers, because it does include, for example, APR, which is a critical item that has to be on the worksheet. So it provides everything that's, from a regulatory standpoint required. So it gives you true numbers, but without, again, having to go through the formal application process, which a lot of people really are not wanting to do when they're first mulling over, getting a mortgage. They just want to get some information. What I'm basically doing with this offer is to, help you by giving you or offering you more detailed information for your research as to what's available with loans out there for your situation.
Well, that leads to this last question was, and it kind of goes to this trigger lead idea. So if I sent you my information through your email and you gave me this information, now are you selling my name and email address to these other people, or is it now okay, it's just you and me?
Yeah. We in the whole 20, or what are we on now? 26 years of operating, we've never sold any of the information we have, consumer information, to any third parties ever. We never have, never will. So no, and in fact, that's the other thing about offering these closing cost worksheets. Notice I said credit score, and what I mean by that is what the requestor thinks their credit score is, because that's what I'm going to base the numbers on. So if the person requesting the worksheet turns off to be wrong about their score, well, it's going to affect what I sent them. And of course, if they've learned later that what they gave me was wrong, just let me know and I'll revise the worksheet for their, what they believe more accurate credit score is. But we're not going to pull credit with this kind of a request. We're going to go by whatever the consumer, whatever the borrower, prospective borrower thinks their credit score is, and then we'll go from there if they decide they want to get more seriously into the process.
So that trigger lead then occurs whenever you or another lender would actually do the credit request.
Yeah. Good question. Let me clarify that. A trigger lead is going to be triggered by when we or any mortgage lender, mortgage originator pulls a 3-bureau MERS report. That's going to create a hard inquiry. So it's the hard inquiry that gets sold as a trigger lead. Now, we do have the option, and I do use it actually even more lately, actually for cost reasons as much as the other reason, which is, and the reason is because I can offer a soft pull report. So I can pull a soft pull report that gives me the borrowers all their debt information and their credit scores, but it doesn't create a hard inquiry that's sold as a trigger lead. So when I have an initial inquiry about somebody who's like a little more serious, they really are close to wanting to apply, but they're still not sure and they don't know what their credit score is. And if we need to find out, I will offer, hey, look, I'll pull a soft report. This way I can get your actual scores and get your actual liabilities. So we have accurate numbers for this worksheet. And then if they decide to move forward, well, at that point, we do have to pull a hard report because that's what the industry requires to get into the underwriting process and so forth.
That's great clarification. Hey, before I let you go, I have one piece of or question about a piece of information I was reading into, and it talked about the market and how it is as far as the home prices are not dipping as much as was anticipated with inflation and higher interest rates, which was hoping to drive that down. And they're saying a lot of this is due to there's just still a lack of inventory, and there's a lot of pressure still for new buyers and just not enough inventory. Can you speak to that at all?
Yes, we're seeing it every day. It's very true. I mean, we still have a fundamental problem of a vast majority of the current homeowners, the homeowners stock, if you will. A vast majority of them have very low rates on their existing mortgages and a lot of equity. So as a consequence, many of those are still trapped in the sense that even if they were thinking about selling and moving up, they can't convince themselves to do that and give up that 2 3/4 rate for a 6% rate, particularly given the prices haven't fallen much. So they may be looking at paying a premium price on their home, on the new home, as well as a higher rate. And they're kind of going, this doesn't really pencil out that well. So they're sitting on their hands and they're not selling. So inventory, while it blipped up a little bit, got a little bit better, it's still well below normal. And that's still creating a challenge. Home values are moderating. The rate of increase is decreasing. But the notion that we're going to have a 10-20% drop anytime soon, I think that's probably not valid.
Well, looking into your crystal ball for us, looking here, it's Thursday, April 27th. What do we see for the next week as far as rates are concerned? We're seeing that, as you said, it ticked up a little bit over the 5 days as we look at this. What do we see in the next week?
Well, certainly, like I mentioned, tomorrow will be a key day because of the core inflation number being released. Now, if that turns out to be improved again in March over February, I think that's going to bode well for the bond market. And I think that yield you see at 352, I would predict is going to come down a little bit. Now, into next week, it gets more fuzzy. We do have the Fed is meeting, I think, actually next week. And so what's going to happen there is the expectation is they're going to raise the Fed funds rate at least one more time by 0.25. And I think if they do that, then the markets will be sort of reassured and will be more comfortable with the notion that the Fed is nearing the end and may start lowering rates later this year. And I think so if that plays out that way, I think we could see some improvement in these yields next week as well, maybe getting back to as good as the 340 or below that we saw, over the last 5 days.
It's fantastic. Well, I'm going to put your information up there one more time, Art. It's Art Alvarez of MortgageWorks, 760-883-5700. His website is mwloan.com, and you can reach him on your email to get your free closing cost worksheet at art@mwloan.com. And again, that's one of those things that will not trigger your phone ringing and blowing up with offers and people looking for business. So, Art, thank you so much. I really appreciate it. Any last closing thoughts before we let you go today?
No, thank you, Jeff. Again, thank you, everybody, for listening. And I'll have some more good information, everything about mortgages and the real estate markets next week. In the meantime, just remember, at MortgageWorks, we have the answers, and they're on the house.
Fantastic. Art, thank you so much.
Thanks. Take care.
Bye-bye.